Hi, everyone, and welcome. Sometimes you look at a company's financial report and the numbers just make your head spin. They don't seem to add up at all. Well, today, we're going to untangle one of those reports for a company called Duty Free International. We'll call them DFIL. We're going to solve a real-world financial mystery that on the surface looks like an absolute disaster.
That's right, Ben. And really, this is the big question, isn't it? Just put yourself in an investor's shoes for a second. You see that a company's sales, its revenue, have shot up by an incredible 40%. You're thinking, wow, that's fantastic. But then your eyes go to the next line, and you see that its profits have totally collapsed, falling by over 90%. So what on earth is actually going on here?
Okay, let's just stare at these numbers for a second. On the left, revenue is up a massive 40.6%. I mean, any company would be thrilled with that. But then you look to the right, and profit before tax is down a staggering 93.4%. I mean, these two things just don't belong together. It's like your boss telling you got a huge promotion, but when you check your bank account, it's almost empty. It makes 0 sense, and your first thought has to be that this company is in some really, really deep trouble.
Exactly. So to get to the bottom of this, here's our game plan. First, we're going to decode those crazy headlines. Then we'll uncover the real story behind the profit number. After that, we're going to look at a huge strategic pivot DFIL is making. We'll follow the money to see how they're doing it, weigh the risks versus the opportunities, and then we'll wrap up with the big question every investor should be asking.
All right, let's dive right in. First things first, we have to go straight to the source. We're talking about the company's official report card, its profit and loss statement. We've got to make sure we understand what the raw numbers are actually saying before we can figure out what they mean.
And here they are, the hard numbers right from DFIL's report. You can see it clear as day. In the third quarter of last year, revenue was 41.2 million Malaysian ringgit. This year, it jumped to 57.9 million. That's our 40.6% increase. But then look at the profit line. Last year, a super healthy 42.6 million ringgit. This year, a tiny 2.8 million. And that, right there, is the 93.4% drop. So the numbers are real. They are straight from the official filings, and they set the stage for our investigation perfectly.
So, okay, the numbers are confirmed. Now it's time to put on our detective hats, because this is where we uncover what's really going on. That huge profit figure from last year, it isn't what you think it is. There is one single crucial detail, a one-time event tucked away in the report that completely flips the script on this whole story.
And this number is the smoking gun. 69.6 million ringgit. This number shows up in the 2024 profit statement, but poof, it's gone in 2025. And get this, this one single line item is actually bigger than the company's entire revenue for that quarter. That is not normal. This isn't money from selling goods. This is something else entirely. And it's what's causing all the confusion.
Exactly. That 69.6 million ringgit was a one-off payment from the government. Basically, the government needed some of the company's land for a project, so they paid them for it. This is called a compulsory land acquisition. So trying to compare last year's profit to this year's is like comparing your normal monthly salary to a month where you also happen to win the lottery. Yeah, your income that month was huge, but it's not going to happen again. It makes your regular salary next month look tiny by comparison, even if it's perfectly fine. That's exactly what's happening here.
And you don't even have to take our word for it. The company spells it out for us right there in their own report. I'm going to read the quote directly from their commentary. The lower profit in 3Q FY 2026 was mainly attributable to the absence of compensation received from the compulsory land acquisition of RM 69.6 million. So, there you have it. Case closed. The profit didn't actually crash because the business is failing. It just looks that way because last year's number was supercharged by a huge one-time payment.
Right. So, with that mystery solved, we can finally get to the real story here. And honestly, this part is way more interesting if you're an investor. The big question now is, what is DFIL doing with all its cash, including that big windfall from the land sale? Well, it turns out they're using it to fund a massive strategic pivot that's going to fundamentally change the entire direction of the company.
And this slide lays out their new three-part game plan perfectly. First, they're admitting that their main business, duty-free retail, is having a tough time. They even had to close an important store because of that land sale. So what's step 2? A huge acquisition in a totally different industry, making car parts. The idea is to get a steady, reliable source of income. And step 3? A future project in property development to get value out of the land they still own.
This isn't just a small change. They are actively pivoting away from being just a duty-free shop.
Okay, a new strategy sounds great on paper, but as investors, we need to see the proof. So now, we're going to follow the money. We're going to look at the company's balance sheet, which is basically a snapshot of what a company owns versus what it owes. And this document tells the story of their pivot in a really powerful way.
Whoa, okay, and here's clue number 1. Look at their pile of cash. Back in February, DFIL was sitting on over 230 million ringgit. Fast forward 9 months to November, and that's dropped all the way down to just 94 million. That's a huge drop. Over 136 million ringgit vanished. So the big question is, where did all that money go?
And here is your answer, perfectly illustrated. While that pile of cash was shrinking, something else was growing, a lot. Their physical assets, what the accountants call property, plant, and equipment, shot up from 47 million ringgit to over 126 million in that same time. You can literally see the story right here. They turned cash into physical stuff. This is the pivot happening in real time.
And we know what the biggest piece of that puzzle was. The company spent 175 million ringgit in cash to buy a company called United Industries Holdings. That's the car parts manufacturer that's at the heart of their new strategy. This one deal explains most of the cash drop and that big strategic shift into a new business.
But they're not putting all their eggs in one basket. The second part of this pivot is property development. They've teamed up with another company to build apartments and shops on land they already own in Johor Bahru. And just look at the potential size of this project. The total value is estimated at nearly 500 million ringgit. DF feels slice of the pie is 18%, which they think is worth over $83 million. So this is another huge bet outside of their traditional retail world.
Okay, so it's clear DFIL is making some massive company-changing bets. They took this one-time cash windfall and are using it to completely redraw their own future. But, big moves always come with big questions. So for this section, we've got to break down the outlook for this new strategy, balancing the potential rewards with some very real risks.
Let's talk about the scary stuff first, the risks. Their original retail business is still facing a tough market and rising costs. Plus, they're jumping into a business they know nothing about, automotive parts. That's a huge integration risk. In a property development that big, so many things could go wrong. So those are the big red flags. But Alex, what's the potential upside here?
Well, the opportunities are just as big, Ben. On the flip side, that car parts business could give them the stable income they desperately need. And the report even says they want to work with electric and hybrid vehicle makers, which is obviously a huge growth area. The property project, if they pull it off, could unlock a ton of value from land that was just sitting there. And maybe most importantly, all of this means they're not just relying on one struggling industry anymore.
Okay, let's bring it all home. We started with a headline that looked like a complete disaster. Profits down 93%. We dug in, found the one-off event that explained it all, and then we uncovered the real story, a company using a pile of cash to make a dramatic change in direction. So what does it all mean for DFIL's future?
This whole complicated story really boils down to this one sentence. Duty Free International took a one-time cash payment from the government and used it to fund a massive pivot away from its struggling retail business and into two completely new areas, making car parts and developing property. That's the whole story in a nutshell.
And that brings us to the final and most important question that any investor has to ask themselves now. We've gone way past the misleading headlines to see the real strategy. So is this pivot a bold, necessary move to build a stronger future? Or is it a reckless gamble throwing money at businesses they don't really understand? The jury's still out, but now at least you know the right question to be asking. Thanks for joining us.